with chaos at the New York Stock Exchange.
Get back in there at once and sell, sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put this show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, January 30th, 2026. Big shout outs to Sherry, to Lynn, to all the folks tuning in week in, week out, keeping up to speed with what we got going on over here. Thank you so much. So, hey, let's jump into the numbers, tell you what's going on with the markets. What did Mr. Market do this week? It was a little sloppy, up and down. Dow Jones ended up down on the week, 0.4%. S&P 500 did squeak out a positive return, up 0.3% on the week. NASDAQ Composite was down 0.1%, and the Russell Small Cap Index, giving back some of the gains here year to date, down 2% on the week. I think I know why. I'll tell you about that here in just a moment. Taking a look at the Volatility Index, up 8.3% on the week, coming in at 17 and change. So Volatility Index pushing a little bit higher this week. Keep eyes on that. The long-term bonds, as measured by the TLT, down about 1% on the week, so no traction there. And then we take a look at the different sectors of the market. It was kind of mixed with a little bit extra attention to the defensives, right? Staples up 0.7% this week. Things you need, not things that you want. Doing pretty well this week. Energy continuing to be hot, up 3.7% on the week. Energy up 14.2% year to date. That's on the year, folks. Doing very, very well. Everything else, like I said, kind of mixed. Communication services, that's up 2.6% on the week. You can thank Facebook for that. Meta, they had a really good report, which is one of the ones we do have in our models. And that really kind of drove that sector. But everything else just kind of mixed. And then we take a look at the metals. Metals took a turn lower this week. Gold down 2.8%. Silver down 18.8% on the week. Let me tell you something. Silver was down 28.5% today. On Friday. As a matter of fact, at one point during the day today, it was down almost 34% for the day. Silver just imploding, getting absolutely beaten down. I think my exact words to you the last couple of weeks when it comes to silver is that this has only happened a couple of times in history where we've seen this parabolic move in silver that has always ended in a bloodbath. Well, it certainly looked like one today, folks, because it just took a beating. And look, the way mathematics works with investing, think about it this way. If you invest $100 into an investment and it goes up 100%, right? You're at $200. Lose 50%, you're right back down to where you started. So let me just tell you, 28.5% in a single day, that was a beatdown. And we've been warning everyone about silver. We've had folks that have inquired about silver in recent weeks. We've suggested, hey, if you have some, you really should think about taking some profit. I'm not saying this is the beginning of the end for silver, but it sure did look like it today. It was a pretty bad hit there for the metals. Gold, on the other hand, let me say this about gold. I think gold can go through a bit of a consolidation phase as well. I think it can drift lower. But gold has done a few things in recent weeks that would indicate that it could look pretty constructive looking out a year from now. So we've got our eyes on the gold space. And if we get a good enough pullback here, enough of a consolidation, we may revisit our position in gold. You know, we had gold for years. We backed away from it a few months ago. We did very well with our holdings there in a gold miner out of Canada. At this point in time, we don't have a position in gold, but we are watching it closely and maybe looking to re-enter that because it does still look constructive longer term. Can't say the same for silver. So that's what's going on with all of that. What moved markets this week? There were a few things. First of all, earnings. Earnings are always going to move markets, and we are smack dab in the middle of what some folks call silly season, right? Because earnings reports come out, stocks act erratically. We saw quite a bit of that this week. Sometimes reacting well to positive reports and good news, and sometimes reacting poorly because it just didn't get exactly what it was looking for, Mr. Market. You know, it can be pretty finicky in that way. It's hard for folks to kind of discern sometimes why companies come out with good earnings reports, yet the stocks go down. Well, sometimes it's just one little element in that report that the market's keying in on that it doesn't like, and therefore it goes the other way. And then there's other companies that report a bad quarter, but there's one little element the market likes, and the stock goes up 10%. A lot of times it doesn't make a whole heck of a lot of sense, but that's the way of the market, and that moved stocks around quite a bit this week. In addition to that, I think maybe one of the bigger drivers of the market this week was Federal Reserve news. Okay, so a couple of things. One, the Federal Reserve had their meeting on Wednesday, and they opted to leave rates unchanged. But not only that, they really indicated this week that there's no intention of cutting rates anytime soon. And the market, folks, wants rates lower. They want more cuts. I think that is why small caps took such a hit this week, is because the Fed is not indicating any further rate cuts anytime soon. So I think that played a role. And there's another part to the Fed news this week, and that was President Trump announcing his Fed chair nomination this morning. Now, for a while, I thought it was going to be Rick Rieder. Actually, I thought Rick Rieder had a really strong chance of getting this from the very beginning. Rick Rieder is the chief investment officer for fixed income for BlackRock, which is like the largest asset manager on planet Earth. And Rick is a super smart guy. And because he's a market participant, he's not looking at interest rates just through the lens of an academic. He's also looking at it through the lens of a market participant. And he's going to have an inclination to want rates lower if it can be done, which I kind of thought aligned nicely with the Trump administration's desire to see lower interest rates. So I kind of thought Rick was going to get it. But it was announced this morning, and it's Kevin Warsh. And it was a bit of a surprising pick because Kevin is much more like Jay Powell. He's much more of an independent mind in that way. He's much more academic when it comes to his views on monetary policy. Not as much of a market participant view, but more of an academic view. And the market, I think, what it realized today with that nomination is Fed independence is still squarely intact. Not that Rick wasn't going to be independent. Don't misunderstand what I'm saying there. I just think Rick had a natural inclination for lower rates. What the market saw today was Fed independence is here to stay. Kevin Warsh should be a pretty independent guy. Kevin Hassett, on the other hand, could have been a completely different story. So the market reacted to that. And then in connection with that, so not only now do you have a Fed that is not guaranteed to be dovish, not guaranteed to be cutting rates and doing what their administration wants, but on top of that, we had a producer price index. Okay, that's inflation on the wholesale level. That was just through the roof this morning, folks. It was a really nasty number, much higher than anyone expected. And if inflation is high on the wholesale end, that could bleed through to the retail side of the equation. And inflation may be a story yet. We talked about that last week. I mentioned last week that I read a really compelling piece about tariffs, about the fact that so much inventory was front-loaded pre-tariff that really the economy has just now worked through a lot of that. And we really, in some ways, have not felt the impact of tariffs. That producer price index this morning, that could be an indication of what's to come in regards to inflation. So if you've got an independent Fed and you've got inflation pressing higher, let me tell you what would shock this market. If you all of a sudden have a Fed talking about raising interest rates again, watch out. Watch out. Market is way off sides for something like that. But when you look at the way gold and silver moved today, again, I think it's a combination of a hot producer price index and independent Fed. I think that really helped turn the tide on these metals. So we'll be watching all this stuff real closely, but I think these are the things that moved the market the most this week. There's also some tariff talk this week. President Trump, sometimes, as much as I support a lot of his initiatives, I would liken it to a baby with a hammer. Seriously, I mean, the tariff things that come out of this administration on a daily and weekly basis, it's enough to make your head spin. If there's something they don't like somewhere around the world, all of a sudden there's a big, huge tariff being talked about. And it's just creating a lot of uncertainty. Market is sensing that. Look, the Supreme Court has not weighed in on this yet. There's still a question to the legality of the president being able to implement all these tariffs. And I have to say, again, as much as I support the initiatives, understand this, folks. Look, we've been being taken advantage of by our trading partners for decades. These are issues that needed to be addressed. Hands down, I support it 110%. But I don't support, what makes me concerned is I don't think one person, look, I've always told clients, when it comes to presidential election time, we stop sweating it. Quit worrying so much about the next president, because presidents only have but so much power. They can only do but so much good or so much bad. And in the whole scheme of things, they're not that powerful when it comes to the U.S. economy. And when you look at economic results and stock market results through any president, Democrat or Republican, they're rather similar throughout history. There's really not a whole lot of difference. But what concerns me about this tariff situation, all of a sudden, one man does have a whole heck of a lot of power. I mean, enough power to shut down the entire global economy, right? And I don't think the Supreme Court's going to support that. So we'll see. But the market at this point doesn't have anything else to go on. So when tariffs are talked about, it's going to react. And we're seeing a lot of that as well. So a lot going on out there. Look, more earnings yet to come. That's going to be moving markets next week. We'll see how all that shakes out. See if this weakness in the market continues. We'll see if metals continue to go lower. Hey, I like where we're sitting right now. For all you new clients or folks that have added new money to your portfolios in recent weeks, we've been really working that into the models here the last couple of weeks of the market being soft, trying to get that money worked in on opportunities, and that's what we've been doing. Looking to do some more trimming in the models. We've talked about that as well. So as those opportunities come, we'll be doing that as well. But I like where things are positioned for us right now. We're in really great shape and have the flexibility to kind of move whichever direction we need to. And I think that's the story for 2026. Be disciplined, be diversified, and be at the ready. And that's what we are. So I'm going to wrap up, folks. But hey, between now and next week, as you're thinking about your future and your long-term goals, all the things you want to do with you and your money. Hey, maybe it's buy that house on the coast of Puerto Rico. Beautiful country. Yeah, shout out to you, Chuck. Chuck loves Puerto Rico. Hey, maybe it is put your kids through college. Maybe it's retire a little early or just retire comfortably. Hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.